Hey team, it's Ray Campbell, Fairway Independent Mortgage. Today is Friday, July 12th. We've got a lot to cover for you today. We're going to talk about bond market information, current interest rates, some Fed talk as well, the September rate cuts possibly where a lot of people are focusing, and then refinancing opportunities. This is information you're going to want to get out to your clients, past clients, current people looking for homes, home buyers, sellers. This is going to be a little bit of a longer video than normal, so I'll cut to the chase, get to the first part of it. If you want to watch the first couple of minutes, that'll get you kind of the basic weekly information or market information that we try to get out to you as things change. We haven't been doing these consistent weekly because there hasn't been a whole lot of change going on, but we are starting to see this really start to move for us. So let's get into it here. So bond market information, of course, mortgage-backed securities control mortgage rates. The Fed does not. Inadvertently, they can, and they've been doing that, and we'll get into that a little bit when we start talking about the Fed. But bond pricing is starting to improve. That means that interest rates are starting to improve. We've had a really, really good week. We're starting to see where you can get interest rates that are down in the low sevens, high sixes, sometimes without even buying down points. I know that when I send these updates out and I tell you these are what the interest rates are or going to be, that we talk about discount points a lot. A lot of lenders have been charging discount points, sometimes excessively, to get the interest rate down, because the interest rate is a big fear for a lot of home buyers right now. The affordability, the cost of homes going up, and then the interest rates going up really kind of put a damper on things for us. So right now, looking at yesterday's numbers, the average 30-year fixed rate that was locked yesterday across the country, 6.757. Of course, keep in mind that does not account for how many discount points people are paying to get there if they need to. For example, I did quote one yesterday, 6.375%, that did have discount points on there, but everybody's situation is a little bit different. But you are seeing those, and I know that I've seen some interest rates as well down into the fives. Again, different situations for everybody, so make sure that your buyers are looking at those numbers and comparing those numbers to make sure that they're not excessively paying discount points, right? There's going to be some refinance opportunities coming up here as well, and we're getting into that time where I'm starting to consider looking at my past clients for refinances and looking at those numbers too. So current rate 6.757 as of yesterday for 35% of locked loans in the entire country. Now the Fed. So we got some really good inflation numbers. The shelter cost is actually coming down finally. We know that was artificially inflated in the inflation numbers, and those are starting to come down for us, and that's a good thing. That's helping interest rates. That's helping the Fed decide what they're going to do. The September quote-unquote rate cut that has been thrown out there, there's a good chance that the Fed's going to cut interest rates in September. Now, who knows if that's going to happen, but that's the talk on the town. That's what's going to happen. So we're going to get into a little bit of a deep dive on that and what that means here. So if you want to jump off here, I get it, understand. This is going to be a little more deep dive into some of those things that people really need to understand, but probably don't have the attention span to sit here and geek out on numbers and what's actually going to happen. But if you're still watching, appreciate it, and would like to get into some of that with you on the Fed and the Fed rate cuts. So in general, what typically happens is when the economy is going really, really strong, that's going to cause inflation. And inflation is the arch enemy of mortgage bonds or long-term investments really as a whole. When the Fed raises or cuts rates, that's an overnight rate that they're lending to other banks, basically. So the large banks or regional banks or anybody that banking-wise can go to the Fed window, they can borrow money. It's an overnight rate. It's going to be a certain percentage. That's what they control. They can raise that and lower it. They raise that to increase the cost of funds to slow down the economy, right? So, and that's what they've been doing. They raised it really, really fast to slow down the economy, because as the economy grows, it causes inflation. And inflation, of course, is not a good thing. That's one of their other mandates, is to control inflation while continue to have, good economic growth, but not let it get out of control. So they raise interest rates. When they raise interest rates, that slows the economy and it brings down inflation. That's the key to what we've been looking at and needing to see from the Fed, is that the inflation is going to come down. Now, housing costs in their numbers that they look at, the PCE reports and CPI reports, those have been artificially inflated because those numbers, there's a big lag, 9 to 12 months of those numbers when they peak and when they come down, and we're starting to see them come down now. And that's what's causing our inflation to come down, and that's what's helping our mortgage-backed securities and mortgage bonds. The other thing that is a big factor in the Fed is what they're doing with their balance sheet for treasuries and mortgage-backed securities. So go way back in time to 2008. 2008 happened, 2009, 2010 comes, and we had all this regulation go into place. Well, and all of these things, well, the government stepped in and they purchased mortgage-backed securities and treasuries. We all know supply and demand, when you have more or less of the other, the cost is going to go up and down depending on supply versus demand. So they bought all of these mortgage-backed securities and treasuries, and that brought interest rates down, say roughly into the 4s. They continued to reinvest that, which helped bring them back down a little bit further, and continue that streak of low interest rates, right? So 2013, we were expecting them to start pulling out of that. They didn't. They continued to reinvest. Well, at some point, they got to pull the Band-Aid off, and that was announced basically September of 21. And very shortly after that, that's when our interest rates started to jump up really, really fast going into 22. And we started seeing 8%, 7% rates. You know, things got a little crazy really fast, putting a halt on a lot of different things. So right now in June, a month and a half ago, is when they started to hold on letting those run off. Okay, so every month those investments expire, they roll off the balance sheet, and they now have to be sold. So you have extra supply, right? Well, that's what causes the interest rates to go up. The bond pricing, you have to pay more. So interest rates went up. They paused that. They announced they were going to do it in June. They were going to pause some of it. Let's, reinvest a little, maybe like here and there. There's a bunch of different numbers. They didn't really do anything with mortgage-backed securities because there wasn't enough rolling off, because, well, everybody's at a 3% interest rate. So you're holding on to it. You're not refinancing or, paying those off. You're just letting them sit, right? And rightfully so. So they are pausing on letting those roll off, and that's caused interest rates to come down. And now inflation numbers are getting better, and that's also helping bond pricing get better, which is helping our mortgage rates get better. So September, everybody is talking about September and the Fed rate cuts. And we've been asked multiple times just this week, what do I do if I lock in an interest rate now and I buy a house now or a refinance now, and then rates come down in September? Well, here's the thing. When the Fed cuts rates, that's not a good thing for mortgage bonds. That actually spurs economic growth, which causes inflation. And inflation, as I just said, is bad for mortgage bonds and your long-term investments. So in September, the Fed cutting rates is not going to help mortgage bonds improve in price and help our interest rates, mortgage rates. That's just not how the system works. However, as we continue to see inflation come down month over month and year over year, that will help our mortgage bonds. Okay, so we may see interest rates continue to get better. The expectation is that interest rates will continue to get better for, let's say the next 12 months. We might see interest rates in the low 6s where you're not buying down discount points. We might see interest rates in the mid 5s, right? We don't know where that's going to go, but we do know that it is coming down. The misconception is that in September they're going to drop all of a sudden. That's just not going to happen, because that's just not how it works. It may drop in September. They may come down in September, continue August, September, October, November. They may continue to come down. But the reason behind that is not specifically going to be because the Fed cuts rates in September, if that's actually what they do. So a little bit of misconception on the news that's out there right now on Fed rate cuts and what's going to happen there in September. If they do it earlier, there's another meeting, July, we may not see what you think the news is saying, or it's just a misconception basically across the board on what happens when the Fed cuts rates. And if you don't study this every day, like I have for the last 20 years, and watch all the bond charts and watch the news and see what's happening, then this is not, common information for everybody to know. So that's what we're looking at for the Fed and what's coming up with inflation and mortgage rates. We do expect them to continue to come down foreseeable future here, probably the next 12 months. I'm using a 12-month time frame because the inflation reports that the Fed looks at have a 9 to 12 month lag. So we should see this continue on pace for roughly 12 months, maybe longer, maybe a little bit less, but that's the plan. Now, one of the other things that's happening is refinance activity is picking up. It's picking up significantly, and this is a very important topic that we all need to have, okay? So when looking at a refinance, you're gonna have clients, past clients, current homeowners, everybody looking at it going, well, should I refinance? I have an interest rate at 7.5% or 8% or something. If we're looking at a 6% interest rate, right, or 6.5, I'm sorry, let's say, we're at 6.757. The question there on a refinance is what's going to happen in the future? What are your chances of refinancing possibly again? Now, keep in mind, churning, which is doing a refinance after refinance after refinance, is not allowed. It's very frowned upon, in fact, illegal for us to churn loans. However, that has to do with rolling in closing costs and having all these excessive fees to do a refinance and then 7 months later do it again. We don't want to be doing that. We don't want to pay $10,000 in closing costs or $5,000 and then 7 months later do it again, and then 7 months later do it again, and now all of a sudden you owe an extra $20,000 because we talked you into a refinance. And that is the point that we want to get across to everybody right now about the refinance opportunities that are in front of you. So you may be at a 7.5% interest rate and have the ability to go down to 6.5. Okay, the question that we have to look at is how much is that going to cost you? There is a possibility that, every mortgage company out there has been saying for the last, 18 months or so that you'll get a free, we all know nothing's free, but you'll get a free refinance from that mortgage company down the road, right? Nothing's free. It's there somewhere, built into the interest rate, rolled into the loan. There's a lot of different ways for us to put it together. We use software. If you did a loan with us, you know that software, we put all your options side by side. You get to look at them and see what the cost is over time, the actual cost, dollar for dollar, where that money's going, if it's the right move or not. This is what you want to look at. You don't want to look at, well, I'm saving $200, $300 a month. That's important, but this is the biggest debt of your life, typically. It is the largest asset of your life, and we want to help you manage that and make sure that you are making the right decision financially with the refinance opportunity that is in front of you, okay? So when looking at a refinance, make sure that you're looking at all the numbers. You're gonna wanna shop for this, okay? Even with me, if you're having a conversation with interest rates and refinance opportunities, I get it. You wanna get the best deal. We're gonna give you a good deal. We cannot be the absolute lowest cost out there, period. Okay, there's reasons for that, and we can talk about it. But you want to make sure that you're just looking at all of the numbers, not just this is what it's saving you. There are a lot of ways to put these together. Rolling in closing costs, paying them out of pocket. Do you include what you're going to get refunded from you from your escrow account if you have one? Do you pay points? Is now the time to actually do it? Do you want to wait until September? Do you want to do it now? Do you want to do it now with a no cost refinance, meaning it's basically rolled into the interest rate and the lender's paying your closing costs because there are third-party fees involved in a refinance. So they're there somewhere. What's the best way to structure it for you and your situation? Look at your options. Make sure that you're having those discussions with your loan officer. If you'd like to have a second opinion, get one. Make sure that you're comparing those numbers and you're looking at all of the numbers, not just this is how much it's saving me on a monthly basis, because it may cost you more in the long run than what you think it might. So hope that helps you guys, and you enjoy the videos. Click like, subscribe, share, share this with your clients, share this with your friends, your family, have the discussions with everybody when it's coming up, the barbecues and the pool days and all that through the summer. Everybody's going to be talking about interest rates and refinancing and what they have going on. So Feel free to reach out to me or my team if you like. All of our contact information is on the page here in our description and bio, basically. But you can always call us at 214-441-7496. And if you need anything over the weekend, we're always available. Have a great one, guys. We'll talk to you soon.